What if I told you there's a new suite of Canadian ETFs that writes covered calls not once a month, but almost every single trading day, with annualized distribution rates approaching 20%? My name is Rashid. I'm a CPA with a master's degree in finance. I'm not a financial advisor, so always do your own research before making any investment decisions. In this video, we're breaking down CDAY, SDAY, QDAY and BDAY. How this daily options strategy actually works, where that eye-catching distribution rate comes from, and the real risks hiding underneath it. By the end, you'll know exactly what's driving the income, and whether a strategy like this could ever make sense inside your own portfolio. Let's start with the term at the center of all this, zero-DTE, pronounced zero-DTE. It stands for 0 days to expiration. It refers to an option that expires at the end of the current trading day. In the DayMAX strategy, the sequence is simple. The market opens, the option is sold, the premium is collected, and the contract expires that same afternoon at market close. That's a very different rhythm from a traditional covered call fund, which typically writes one option per month and holds that position, and that ceiling, in place for weeks at a time. With a zero-DTE approach, the fund resets its position every single day instead. Hamilton's DayMAX funds package a zero-DTE strategy inside Canadian-listed ETFs, adding a modest amount of leverage to increase both exposure and potential income. It's worth flagging up front. These are enhanced income funds, not conventional index ETFs. They're built specifically to generate frequent income, and that design comes with trade-offs we'll walk through carefully over the next few minutes, because the mechanics behind the income matter just as much as the income itself. The lineup includes 4 funds, each targeting a different exposure. CDAY focuses on Canadian dividend stocks. SDAY focuses on US dividend stocks. QDAY focuses on US technology. And BDAY focuses on Bitcoin exposure. Same daily zero-DTE structure and the same leverage approach, but the underlying holdings, and therefore the risk profile, differ quite a bit from one fund to the next. That's an important point, because DayMAX isn't one single strategy with one single risk level. It's a framework applied across 4 very different underlying exposures, and each one deserves to be evaluated on its own. Let's start with CDAY. This fund holds the Hamilton Champions Canadian Dividend Index ETF, giving exposure to established, blue-chip Canadian dividend-paying companies. On the surface, that looks like a straightforward Canadian dividend holding, the kind of fund a lot of Canadian investors already know and understand. But there's a twist in how the options side of this fund actually works, and it's worth understanding before we move on, because it changes what's really driving CDAY's income. CDAY owns Canadian dividend stocks, but it writes its daily options linked to the S&P 500, not a Canadian index. That's because a comparable Canadian zero-DTE index options market isn't currently available. This creates a mismatch between what the fund actually holds and the index its options overlay is tied to. In practical terms, CDAY's option income is influenced by US market volatility, not necessarily the volatility of the Canadian stocks sitting underneath it. It's not a flaw exactly, it's simply a structural reality of how this product had to be built, and it's the kind of detail that's easy to miss if you only look at the headline distribution rate. Next is SDAY. This fund holds a portfolio of US dividend stocks through Hamilton's US Dividend Index ETF, and it also writes daily options linked to the S&P 500. Unlike CDAY, the holdings and the option index here are more closely aligned, since both the stocks and the options exposure sit within the US market. That alignment makes SDAY's mechanics a little more intuitive to follow than CDAY's, even though the underlying zero-DTE and leverage risks are essentially the same across both funds. Then there's QDAY, which holds a US technology portfolio through Hamilton's Technology Index ETF and writes its daily options on the NASDAQ 100. Technology tends to bring higher growth potential, and usually higher volatility alongside it. In a zero-DTE strategy, that volatility directly shapes how much premium gets collected each day, and how much risk comes with it. More volatility can mean richer option premiums, but it can also mean sharper swings in the underlying holdings themselves. CDAY, SDAY and QDAY were the original DayMAX funds. BDAY was added later, applying the same structure to Bitcoin-related exposure. I'll keep this brief since our main focus today is CDAY, SDAY and QDAY, but it's worth saying plainly. Combining Bitcoin exposure, daily options and leverage creates the most aggressive risk profile in the entire lineup. Here's the trade-off at the center of the DayMAX design. Each 0-DTE option generally produces a smaller premium than a 1-month option would. DayMAX can establish new option positions on roughly 250 trading days a year, compared with about 12 monthly cycles for a conventional covered call strategy. But more option cycles don't automatically produce a better total return. It simply means more frequent premium collection, which is a different thing entirely. More frequency can smooth out income over time, but it also means more exposure to the specific mechanics of short-dated options, day after day after day. Because each option expires at the close, the fund typically enters the next session without an option ceiling already in place. Hamilton emphasizes that a meaningful portion of historical equity returns has occurred outside regular trading hours, so the portfolio can retain exposure to those overnight moves in a way a monthly covered call fund, locked into a static ceiling for weeks, doesn't capture in quite the same way. That's part of Hamilton's rationale for the strategy. It's a reasonable argument, but it's not proof that DayMAX will outperform a monthly approach over time. DayMAX funds also borrow cash to bring total equity exposure to approximately 125% of net asset value, roughly 25% leverage, applied through a Canadian financial institution rather than derivatives. This can increase both income and upside participation when the portfolio rises. But it can also magnify losses and accelerate NAV declines when the portfolio falls. It's a real added layer of risk sitting on top of the daily options strategy, not simply a yield booster, and not something to gloss over when you're comparing DayMAX to an unlevered covered call fund. So what does this actually pay? As historical snapshots from late July and early August 2026, CDAY's annualized distribution rate was approximately 18.24%, SDAY's was approximately 18.26%, and QDAY's was approximately 19.71%. These figures aren't guaranteed and can change, sometimes quickly, depending on market conditions and how the underlying options strategy performs. And this is the most important distinction in the entire video: the annualized distribution rate is not the same as total return. A fund can pay a distribution even while its NAV declines, which means the number on the fund page doesn't tell you the whole story on its own. Looking at total return rather than distribution rate, CDAY's 1-year total return was approximately 35.7%, and SDAY's was approximately 16.6%, as of early August 2026. That distinction matters because it captures both the income received and what happened to the fund's unit price. It's the number that tells you what actually happened to your money, rather than just what was paid out along the way. Keep in mind these funds have only about a year of history, mostly during favorable market conditions, so they haven't yet been tested through a full market cycle that includes a sustained downturn. Now let's talk about the risks that don't usually make it into the marketing material, starting with gamma. Sellers of 0-DTE options can carry short gamma exposure, meaning the option's sensitivity to price changes may shift very quickly when the underlying index makes a sharp intraday move. This doesn't automatically cause losses, but it does make the position more sensitive and harder to manage as expiration approaches. For a fund systematically selling these options every single day, that's a risk the strategy is exposed to on a near-daily basis, rather than the more spread-out risk profile of a monthly covered call fund. Like any covered call strategy, DayMAX funds exchange part of the market's upside for that option premium. A strong rally during the trading session can leave the fund behind its underlying holdings for that day. Premium income is earned by giving up some upside. That's true whether the option is written monthly or daily. DayMAX just does it far more often, which means the ceiling gets reset constantly, but it also means there's a limit on the upside almost every single day the market is open. And then there's the leverage risk. A falling equity or Bitcoin market reduces the value of the underlying portfolio, and the approximately 25% leverage magnifies the decline. High income doesn't provide complete downside protection. That's the trade-off worth sitting with, especially in a genuine market pullback rather than the mostly favorable conditions these funds have seen so far since their launch. The option premium can keep flowing even as leverage works against the fund on the way down, and that combination is exactly what investors need to understand before allocating meaningfully to this category. So who might these funds actually make sense for? Experienced income investors who already understand covered calls, who accept the leverage involved, and who would use DayMAX as a limited component of a diversified portfolio. These are better suited as a satellite holding than as a core position, one piece of a diversified income approach, sitting alongside other, lower complexity holdings, rather than replacing them. On the other side, conservative investors, anyone relying on stable capital, and investors drawn in only by the headline distribution rate should carefully examine the mechanics and risks first. Here's the rule I'd apply. Don't buy a complex fund solely because of its distribution rate. Understand what's generating that income, the daily options, the gamma exposure, the leverage, before you allocate to it, not after. DayMAX is a genuinely innovative Canadian income strategy, but its high distributions are compensation for real, specific risks, daily options exposure, gamma sensitivity, and leverage, with the potential for faster NAV movements during a downturn. It may be appropriate as a limited satellite holding for experienced income investors who understand covered calls, leverage, and the possibility of NAV declines. Not as a suitable core portfolio holding, and not as a set-it-and-forget-it income source. Judge the strategy by total return over a full market cycle, not just the distribution rate. The full article is linked in the description below, and my free model portfolios are linked there too. If this video helped you understand DayMAX a little better, hit like, subscribe for more videos like this one, and let me know in the comments. Would you ever hold a DayMAX ETF, or is the combination of daily options and leverage too aggressive for you? Thanks for watching.